I'm Adam Johnson. I'm with NAI Hiffman, Hiffman National. I run our office capital markets group. We focus on office. We'll do some small flex industrial sales throughout the Midwest and Chicago. We try to stress to lenders and special services to try to get in front of the problems as early as you can. In many cases, we'll see lenders, take these buildings back too late, and by that time, we're playing catch up. And so, we want them to get out there, get early, understand the project. Usually, when borrowers know they're underwater, they start to skimp on maintenance and capital projects. So what ends up happening is the lenders inherit all of these problems. So it's important to understand, what you have, understand what your HVAC systems are, your roofs, your parking lots, what some of the insides of these spaces look like. In many cases, we find lenders haven't seen the building since they originally underwrote the project. And so it's important to just get in there and understand, really what you got. And lastly, I think part of it is tenants. Tenants know when buildings are usually underwater. A lot of that information is now more relatively available. And they'll start looking for different buildings. New tenants aren't going to look at that building. The brokers know the building has no money. There's opportunities for the lenders to step in well before they're going to possibly take that property back and could come in and correct and could fund tenant improvements and leasing commissions. They may come in and fund a capital project because they need to make sure HVAC is working, or you could end up with mold or different remediation issues. All of those things are things that if the lenders are out ahead of it 1, 2 years in advance, talking with the borrowers, talking with groups like us that can advise them and say, hey, here's the things you should be doing now before you take control of the property. And if you can do that, then a lot of times these lenders will have a much more successful project, when they do take it back. It's all private capital now, for the most part, that's looking at office. I call them the widget makers. They tend to have some type of other business where they made the majority of their money that provides consistent cash flow to some certain extent. And so for them, they're taking bets with some excess capital. They're kind of coming in and plugging the hole where institutions used to be. And part of that reason is, some of those checks used to be $150, $200 million checks to buy some of these buildings. If we just look at like a downtown Chicago right now, you can write a $25 million check for the same building. And so that's, bringing this new group in that can, write those checks initially. And then you're seeing the syndicators kind of lop onto them as well. The groups that used to have the institutional money as their capital partners now have, sometimes it's a doctor, sometimes it's some type of logistics company owner that's very successful. It's all sorts of walks of life that are now kind of entering this market, trying to see if they can hit that home run, with the low pricing. So different buyer setup than what it used to be. And eventually, as things get better, that will change. But right now, it's opportunistic buyers that are involved. Well, I think if you go back and look at, 21 and 22, nobody really knew what to do. Interest rates were so low that things still functioned and worked, and that kind of, propped everything up because interest, money was almost free. In 23, you had everybody pause, not really knowing what to do. Work from home wasn't quite there yet. There were no buyers. When someone would say, "Oh, who do we sell this to?" And we said, "Well, I don't know. It's going to be somebody random that just comes out of the woodworks." Now, when we call somebody and we say, "Hey, we've got an office building for sale," they don't go, "Not interested." They'll say, "Okay, well, tell me about it. Where's it at? What do you think leasing velocity looks like?" So now that we're getting those questions, so I think, for us, the opportunity is there are buyers now. The pricing's not there because debt is still expensive. Although capital is flowing well into a lot of asset classes, it's still a little bit stagnant on the office side. Um, and construction pricing continues to climb. And an office construction pricing is so important because office is such a capital intensive asset class that if that pricing keeps going and the rents don't climb with it, all you get is declining pricing, right? So that's where the pricing isn't quite there yet, but the buyers are. And the buyers are there because I think a lot of these lenders and special servicers, especially, have said, all right, we don't think it's getting better next week, next month, next year. So we should just go now. And I think that's where some of the confidence is. I think, secondly, it's also because they've had the ability to write it down now over years of time to finally get to a point where they can meet market on pricing. Where when they first take it back, they may not be able to take a loss that large in that first quarter, second, or even over a year. They may have to take it over a couple of years of time. And so I think we're seeing that preparation, but you're seeing trading start to happen, which is important. Because office is so capital intensive, a lot of times your first check is not your largest check. You're going to buy a building, and again, we're just going to use some basic numbers. You may buy a building for 15 million or 20 million dollars, and then you may spend 80 to lease it up. That interest rate is not just on that first initial sale. That interest rate hits it all along as you go. In many cases, you're buying the building in cash, and then you're putting some type of bridge debt or construction debt on it, which tends to be very expensive. So as those interest rates stay high, that bridge debt is going to be really, really expensive. When we look at as you add to those loans throughout that construction process, same thing, having those interest rates elevated, having larger spreads in the office sector compared to other sectors, all hits the bottom line. And so at the end of the day, when we do our models, that bottom line just trickles down to what these buildings end up selling for. And that's the challenge with the interest rates. Having a 6.5% interest rate or 5% interest rate, yes, it moves pricing because of what that gap is, but that's not ultimately what's causing the problem. It's the availability of capital throughout the process of doing a lease up. That's the most important. So that's where I think debt interest rates kind of fall into play. In terms of the herd mentality, this I think we're seeing, and what's kind of nice is you can see it easily with downtown Chicago. And to go through just a couple of like quick stats, in 23, you had 1.9 million square feet sold in downtown Chicago for about 213 million. In 24, about 9.5 million square feet, so 660 million. In the prior 12 months for 25, you had about 12 million square feet, 675 million. So we're climbing. In the last 6 months, you've had 10 million square feet for almost 700 million, right? So you're seeing, it used to be there was a building a quarter that was being sold, and then it was maybe about a building a month, that was hitting the news. Now there's 1 to 2 a week that you're seeing is either going under contract or being sold downtown. There's two things happening. One of them we talked about earlier, which is you've got lenders and services going, okay, I think we're done. We've written it down far enough. We're out and we're selling. I think that's one part, right? There's more sellers right now than what there was a couple of years ago. But the buyers are starting to fly in. No one wanted to be the first person. A couple people bought buildings in 23 when nobody wanted to touch them. They've done very well because they've been able to get out and lease ahead of time because they've been one of the few buildings with capital. Now, as more and more buildings sell, more and more buildings will have capital. It will get more competitive. But for the folks that are the early adapters, they're going to have an advantage where, there's going to be X amount of buildings that are refreshed, have fresh funds, have fresh energy with the new ownership, which I think is very important. I don't think people sometimes realize there's an energy to buildings when you walk in them, when you see people, when people are greeting you, people sitting in lounges, there's an energy to it. And that's what a lot of these new tenants want when they go into a building. You want to attract your staff back to a property. You want them to walk in and be excited to be there, to see people. These new owners are doing that. So there's definitely that herd mentality that's happening because as one person buys, the next one buys, and then they start to see them lease up, and that's where they get excited. You've got leasing velocity starting. When you look at just pure leasing, leasing's up 25% across the country for office. Now that's being led by New York and San Francisco, right? So it's starting kind of on the edges. Chicago's a bit of a laggard, but it always is. New York usually is the first one to start, and then it spreads from there. So I think that's a positive indicator. People are looking at saying, all right, I now feel comfortable that if I buy a building with a lot of vacancy or 30 or 40% vacancy, there's enough deal velocity that I can fill it. Now, is it where we want it to be? No. Is it highly competitive for these deals? Yes, because we've got high vacancy. But the more and more these buildings get improved, the more money that gets put into it. Again, the more good news and energy that happens in these markets, because it's not just buildings that have to create that energy. It's, entire sectors and areas, it's entire streets. When you look at the loop, what they're trying to do with Google opening, all of these things create energy, not just within a building, but around buildings. And so, that all creates that herd mentality when every time you click on a news story, if the first thing you see is office is dead, it's dying, nobody's going to work. Not a real good tagline for someone looking to buy an office building. Now, if you look it up, all you're reading about is the new people that are buying buildings, the amount of money they're putting into the buildings, these beautiful office spaces and lobbies and lounges and rooftops and all of these different things that are being done in these buildings to create a great work environment, and ultimately that's what these companies want is they want a great work environment so they can get people back in them rather than sitting at home. I think for us, it's a great opportunity to meet, folks in leadership positions, decision makers, and understanding where their mindset is, um, with how they're approaching some of these assets now. As I kind of talked about, it seems to be we're seeing more and more kind of cut bait and say, okay, let's start selling. For us, this is a time where we can intermingle and talk with multiple people and figure out, where are their problems? Where are they seeing cracks? They're going to see it before, we will, because they're talking to folks before those buildings come to us, before they come to us with the problems, for us to hopefully try to solve. They're going to see some of those cracks. How are the discussions going, with the borrowers? Are they having issues? So for us, it's a great time to be able to, talk high level, learn. We always learn a lot when we come to these events, and I think that's the biggest takeaway is what can we come learn, to help, kind of sharpen our tools. I think for us, at the end of the day, we're the bricks and sticks. And what I mean by that is, we're the ones that are touching, feeling on the floor, for these types of buildings. We're doing property management, and we have over 100 million square feet. So it allows us to, really be able to dive in and see trends that are happening in pricing. How do you revitalize a project? We're in 27 states, so it also gives us a flavor of what's happening in certain markets versus other markets. So again, gives us kind of a little bit more of a macro level view when it comes to the operations of the buildings. And then, from the brokerage side, that's the everyday deals. We do office, industrial, retail, so we see a little bit of everything. But it's being able to dive in, understand the markets, understand what tenants want. Um, Obviously, my group does sales. We do an industrial investment sales. We've got a division that does that as well. So again, understanding, well, what do the buyers want? What are they doing in these buildings? What are the returns they need? We need to be able to translate what the buyers want to the sellers. The sellers always want the highest price, but can we get it? Or if we're going to get that seller's price, what do we need to do to get there? I always tell folks are looking to sell their building, don't call me the day you want to sell. Call me 2 years before you want to sell. Let us help, put in processes to make sure that we can create the most value for you. Whether you intend to sell or keep long term, it's important that you're doing the right leasing, you're structuring deals the right way, you're running your property the right way, you're doing capital projects when needed. We've got a project services group that does that as well. I think they did something like 11 or 12 million square feet of roofs last year. Um, so again, all of these projects kind of all come together for us at the end of the day to, be able to help clients. And for us coming to these events, helps us, be able to kind of utilize, again, our tool set, and talk with folks that have a different type of tool set on the banking world. There's a whole lot of acronyms out there that we learn as we pick up in some of these events. We obviously have our own acronyms too, so it's a good way to kind of be able to translate both going back and forth. Well, I think for us, we have kind of two taglines that we use. One is trusted. At the end of the day, our clients are asking us and they're trusting us to, be good stewards of what are some of the most valuable assets in their portfolio. And we want to be able to come in and provide our expertise to help them in any way we can, whether that's a hold, a sell, or just working on a capital project. And I think the other tagline we use is making lives easier. We have a lot of expertise within NAI Hiffman and Hiffman National, and being able to come in and say we can handle anything from whether it be receivership, leasing, sales, project management, or just consulting. What do you think we should do? We're there to kind of, be an easy button, be a one-stop shop and to be able to help folks. And so they can find us, Hiffman.com, has all of our information there. ajohnson@hiffman.com is my email if anybody needs it. And then we're looking forward to being, at the Bankers Midwest, September 9th and 10th in Chicago.